Can we pivot to Lebanon? It's our other major story. We've got a pretty spectacular chart which personifies the potential for restructuring risk. You say there's an unavoidability of that. You're looking at the March maturity spiking to over 200%. JP Morgan says there is a reluctance by the local banks to participate. Is it inevitable that some structural default actually happens here? Is that how I should term it, phrase it, or is that inappropriate?
Look, the thing is, there are two factors in the Lebanese debt. You have the internal debt and the external debt. The bulk of the issue is the internal debt rather than the external debt.
Yes.
The main thing is that you have maturities that the Lebanese government has to pay, towards the Eurobond, international Eurobond holders. However, if you cannot pay without having a reform in place. So, for example, the reserves currently are dwindling, and if you look at the latest numbers, taking off the liabilities of the central bank, you're around 15 to $16 billion, which are actually, those reserves needs to be used for something else. However, the lack of reluctancy that is coming from the political elite in Lebanon and the way they're acting irresponsibly is actually impacting the prices of those Eurobonds and the pressure on the government. So eventually, it has to be a package of restructuring of debt, reforms, and a new and a plan to how to get Lebanon out of the problem.
So you're staying out of Lebanese assets, arguably, given what you've just said. But in terms of your conviction view, and Manus and I looked through your research earlier, and what really stood out were some of the dividend plays that you mentioned. I mean, we put these together, though, in terms of the projected yield based on the Bloomberg dividend yields, 6.5% at Kingdom Holding, and then you've got the number 4, their National Commercial Bank. Similarly high yields, and actually in some cases higher for the United Arab Emirates, and we took Dubai in particular. Run me through whether these are the names that you're looking at as well, or whether your thinking is a bit different.
Yes, I mean, from a dividend yield perspective, this is what we are actually looking into in general in the MENA region. We are looking into companies that have healthy free cash flows. They are able to pay out to the investors, and you have a lot of opportunities either in Saudi Arabia or in UAE or even in Oman and Kuwait, and such opportunities not only about the absolute dividend yield payout, it's also about the average yield that is in such countries. For example, in Saudi, you have an average yield of around 3%, whereby some of the banks and some of the companies are able to give you 5.5% and 6%. Similar in the UAE, your average yield around 5%, with some of the banks are giving you 7%, and some companies actually giving you 7%. So, from that perspective, I think those companies will outperform, okay, given that the quality names, especially in the UAE, are not abundant. So, so I think eventually investors will go into solid companies which have free cash flows, and they actually give investors those returns. Versus, if you look at it compared to emerging markets, you're much higher. So this is where the key angle that we're looking at.